We've talked at length about pass-through entities, and we're going to talk some more. This is our first Chapter 12 video, T12A, on pass-throughs. Now here is something strange. Nancy organized 11 Corp in 2016, and 11 Corp did not make money in its first year, which is not uncommon for a new business. Because 11 is a corporation, its loss is stranded, at least for now, awaiting next year or the year after, where hopefully it can use its net operating loss against income. Of course, once it starts making any. But Nancy was a busy girl in 2016, and she also started 8, but organized 8 as an LLC. As expected, 8 also lost $40,000 in its first year. The difference is 8 is a pass-through, and thus the loss is eligible to be passed through to Nancy, and perhaps deducted against her ordinary income. Here is the choice of entity and timing getting mixed together, because the pass-through is eligible to deduct the loss immediately, but there is no strange things called a negative dividend. Why, that would be totally upside down. As I just showed, pass-throughs pass through both gains and losses. This can be a real advantage if a startup business is expected to lose money in its first few years. But let's do a flashback to Jim and Pam from Module 1. Recall that they wanted to set up a business, and that business is going to make money, and that money is going to be distributed to the owners. Pass-through comes out on top again. Avoiding the double taxation of the corporate entity generally results in greater after-tax cash flows. However, in a situation where no cash is going to be distributed to the owners, the income did not flow through to Jim and Pam, and thus only the 21% corporate rate applies. However, under the pass-through entity, whether the cash flows flow through or not, the income does, and thus Jim and Pam are paying individual taxes and perhaps employment taxes depending on the entity. When all the cash is being rolled back into the business, it could be that the corporate form is preferred. For example, leaving the earnings in the corporation should result in an increase in the stock price. And selling out the stock, number one, is in control of the shareholder as opposed to dividends, and number two, offers an opportunity for deferral of the income, which we all know is timing variable 101. This creates an interesting problem for small startup businesses that are expected to operate at a loss first, then enter an income generating phase where the profits are likely rolled back into the business, and then finally emerge as a profitable long-term venture. It could be that the pass-through form is best initially to capture the benefit of the losses, then move to a corporate form to sequester the earnings at the corporate level during expansion, and then convert back into a flow-through to avoid double tax once things start rolling. Unfortunately, changing entity forms is not as easy as it sounds, and although beyond the scope of this course, it is definitely fraught with tax problems. Entity planning also provides an opportunity for family wealth planning. For example, a family partnership allows ownership of a family business to be transferred along with the income that flows from it. However, the downside is that you are giving away ownership and control at the same time. In addition, especially for service businesses, giving away a share of the income from a law partnership, for example, to a child is less likely to be sustained since the child cannot possibly be providing legal services on behalf of the partnership. Hopefully by now, you're starting to put together some of the elements of how a pass-through entity works and how entity consideration is critical, and only more so with the narrowing of the tax rates between corporate and other forms. Thanks for watching.